Hello, everyone, and welcome back to the XRP Ripple Insights channel. In today's episode, we're exploring a powerful shift unfolding on the global financial stage. The growing conflict between Iran and Russia, combined with strict international sanctions, is placing massive pressure on traditional systems like SWIFT. But in the middle of this disruption, a new solution is quietly rising: Ripple's XRP ledger. Could XRP be the future of cross-border payments? Could it actually replace SWIFT in some regions? In this deep dive, we'll break down what's happening, how Ripple's technology works, and what this means for banks, businesses, and crypto investors around the world. Let's get into the full story. Few phrases spark more fear inside a global payments department than cut off from SWIFT. Over the past 3 years, policymakers have weaponized access to the society for worldwide interbank financial telecommunication in ways unseen since the Cold War. Now, as hostilities between Russia and Iran's regional adversaries intensify and Western sanctions harden in response, senior bankers are quietly gaming out an unprecedented scenario: a direct Iran-Russia military confrontation that draws even tighter sanctions nets around both nations. Such a clash would all but guarantee that the remaining Russian and Iranian institutions still clinging to the SWIFT messaging network lose their last vestiges of connectivity. In that vacuum, attention has shifted to blockchain-based alternatives, most notably Ripple's XRP ledger, XRPL, and its flagship on-demand liquidity, ODL corridors. Ripple executives argue that their system's ability to settle transactions in seconds without the need for correspondent nostro-vostro accounts could solve the very pain point SWIFT's fragmentation is now amplifying. That narrative is resonating not only in think tank white papers, but also in boardrooms from Dubai to Sao Paulo, where treasurers are asking whether a decentralized rail might finally offer the resilience that geopolitics has stripped from the legacy network. Launched in 1977, SWIFT was never designed to be a sanctions tool. It is merely a secure chat platform that instructs banks how to settle. Yet, because it sits at the hub of more than 11,000 financial institutions in 200 countries, denying access has become the 21st century equivalent of a naval blockade. Following Moscow's 2022 invasion of Ukraine, the EU and its allies expelled a growing list of Russian lenders, forcing them to route messages through slower, more expensive intermediaries or domestic networks like SPFS. Tehran has lived under similar restrictions on and off since 2012, with partial reconnections in 2016 undone by snapback sanctions in 2018, and again in late 2024. The result is an uneasy mosaic in which some Russian and Iranian banks remain patched in for humanitarian or energy trade carve-outs, while others are entirely black-holed, creating fragmentation that introduces latency, manual reconciliation, and operational risk. Critics contend that this Swiss cheese approach undermines SWIFT's reliability for everyone because counterparties must continually verify which institutions remain reachable, adding costly compliance overhead. A hypothetical kinetic conflict between Moscow and Tehran, however improbable it once seemed, would transform today's piecemeal restrictions into a near-total embargo. Washington is already collecting corporate wish lists of which financial prohibitions hurt most in preparation for the next sanctions wave, and European leaders are drafting their 18th package targeting oil, shipping, and, crucially, residual interbank channels. In parallel, Brussels is exploring ways to prohibit shadow routing, where transactions hop through third-country banks that still enjoy SWIFT access. Analysts at Sidley Austin warn that any banks facilitating payments for entities directly supporting either combatant could themselves face disconnection, accelerating the trend toward regionalized financial systems. Within this pressure cooker, the allure of a neutral protocol-level settlement asset like XRP grows. Its ledger is open source, transactions are validated in 3 to 5 seconds, and liquidity can be sourced on demand from global exchanges rather than locked in pre-funded accounts. For sanctioned actors, this means circumventing choke points. For non-sanctioned firms, it offers business continuity should SWIFT splinter along geopolitical lines. Chainalysis data show that sanctioned jurisdictions received nearly $16 billion in cryptocurrency during 2024, almost 40% of all illicit linked on-chain activity worldwide. While Bitcoin and Tether dominate volumes, policy circles are paying closer attention to enterprise-grade networks built for compliance. Unlike permissionless coins whose price volatility scares treasurers, RippleNet wraps XRPL settlement in KYC AML heavy front ends, enforces transaction level blacklists, and offers audit trails regulators can parse in real time. That hybrid model explains why the Dubai Financial Services Authority granted Ripple its first Middle East payments license this spring, and why Portugal's Unicambio already uses ODL to move euros into Brazil in seconds. It also foreshadows how a sanctioned yet compliant entity might continue cross-border trade by funneling invoices through an intermediary fintech in a neutral jurisdiction, paying transaction fees in XRP, rather than sitting on piles of frozen dollars. The precedent is critical. It demonstrates that blockchain rails can satisfy regulators in low-risk corridors, even while offering a lifeline to markets cut out of the dollar system. At its core, RippleNet pairs a messaging layer, mirroring Swift's MT and ISO 2022 formats, with the XRP ledger as a settlement engine. When two counterparties agree to exchange value, the system autonomously sources the cheapest path across market maker order books, converts currency A to XRP, sends that XRP across the ledger in a single block, then instantly converts into currency B on the receiving side. The entire loop typically settles in under 5 seconds, with FX spreads under 30 basis points for liquid corridors. Unlike Swift, which merely transmits instructions and leaves completion to correspondent banks that may sit on funds for days, Ripple offers atomic settlement. Either the whole transaction executes at the quoted rate or it aborts, eliminating daylight overdraft risk. Moreover, the ledger's design caps transaction fees at fractions of a cent regardless of value, making it economical for micropayments as well as billion-dollar treasury swaps. This combination of speed, cost, and finality is precisely what banks say they need as settlement windows shrink and post-trade funding costs climb in a higher rate environment. During a last week's Singapore FinTech Forum, Ripple CEO Brad Garlinghouse stunned delegates by declaring that XRP could capture 14% of Swift's global cross-border volume within 5 years, roughly $20 trillion annually based on 2024 flows. He argued that as more corridors come online, Japan by mid-2025, the UAE already live, and Latin America slated for year-end, the network effect will tip, making it rational for second-tier banks to join, rather than remain in the shrinking Swift universe. Pimps.com and CoinDesk both note that Ripple's value proposition is no longer just speed, but liquidity efficiency. Freeing $10 trillion in trapped correspondent balances could add 80 to 100 basis points of return on equity for global banks at current rates. Critics counter that Swift is rolling out its own instant settlement layer, but early pilots still rely on pre-funding and lack shared liquidity pools. If geopolitical fractures indeed force wholesale Swift bans, Ripple's head start becomes more material because its settlement function is independent of any single sovereign regulator, while its messaging can always plug into ISO 2022 should banks demand backward compatibility. Behind closed doors, Russian and Iranian central bank officials are exploring dual-rail architectures that would link domestic messaging systems, SPFS for Russia, CPAM for Iran, to an open ledger settlement layer such as XRPL. The idea? Keep sensitive message payloads on sovereign infrastructure while leveraging XRP's deep global liquidity to clear trades in real time. Russia's parliament fast-tracked a bill enabling crypto settlement experiments, and pilot payments were expected before the end of 2024. Sources say oil service procurement deals worth $50 million have since cleared over such channels. Meanwhile, Tehran's banks, already plugged into Moscow's switches, are testing whether ODL corridors routed via Dubai can sidestep dollar clearing altogether, settling in XRP and redeeming into dirhams or yuan. Should an Iran-Russia war sever the last SWIFT threads, analysts expect such prototypes to scale rapidly, providing a template for other sanctioned economies. That prospect alarms compliance officers but excites fintech entrepreneurs who see a once-in-a-generation opportunity to build neutral rails insulated from geopolitics. XRP's price has long lagged adoption headlines, whipsawed by SEC litigation and broader crypto risk-off cycles. Yet even skeptics concede that each new high-value corridor adds depth to on-exchange liquidity, dampening volatility over time. Research from finance magnates projects a base case price of 10 toss $20 by 2030 if Ripple captures even single-digit market share of B2B flows, far below maximalist forecasts but materially above today's $2 range. The token's inflation is effectively fixed, with the 55 billion XRP in Ripple's escrow released on a predictable schedule and the transaction fee burn-off setting part of that drip. For investors, the Iran-Russia catalyst serves as a high-beta geopolitical hedge. If sanctions tighten and SWIFT fractures, demand for XRP liquidity could spike. If detente prevails, Ripple still benefits from organic fintech adoption. Either way, XRP emerges as a proxy bet on the fragmentation or re-architecture of the global payments stack. Payments scholar Paulo Tasca argues that the financial plumbing wars of the 2020s will resemble telecom battles of the 1990s. Proprietary incumbents gave way to interoperable IP standards, cutting costs by orders of magnitude. In his view, blockchain settlements are the TCP/IP moment for money. SWIFT could evolve, but its centralized governance and treaty obligations make agility difficult. Conversely, Cambridge Center for Alternative Finance researcher Lingling Chen cautions that Ripple must still solve three hurdles: regulatory harmonization, neutral governance of its validator list, and sufficient redundancy to survive state-level cyber attacks. Yet both agree that should SWIFT bans widen, market forces will accelerate alternative rail adoption, just as Napster drove digital music standards. The likely reality is coexistence. Banks will run dual rails, falling back to XRP settlement in corridors where SWIFT becomes politically or economically unviable, mirroring how telecoms route VoIP minutes when traditional trunks are congested. For all the promise, moving value at the speed of software raises questions regulators have yet to resolve. Chief among them, how to keep sanctioned actors from exploiting open liquidity pools. Ripple responds that its analytics partners screen wallets in real time, and that blacklisting at the address level is easier on-chain than in correspondent networks that rely on batch file uploads. Nevertheless, a determined state actor could spin up fresh addresses faster than watchdogs respond. Additionally, market maker depth in exotic currency pairs, Rial to ruble for instance, remains thin, so spreads may widen during stress, undermining the cost advantage. Finally, the very success of XRPL could invite systemic risk scrutiny akin to what stablecoin issuers now face under draft EU MiCA rules. Banks adopting XRP must therefore architect robust risk controls, ensure they can roll back to SWIFT or domestic rails if on-chain liquidity dries up, and educate regulators to avoid knee-jerk crackdowns that could leave them stranded mid-transition. For crypto investors, the Iran-Russia flashpoint is less about immediate price spikes and more about a structural call option on payments rail disruption. Portfolio managers seeking diversification away from dollar-centric assets may allocate a single-digit percentage to XRP as a geopolitical hedge. Corporate treasurers in emerging markets, meanwhile, should pilot small-value transactions through licensed ODL partners to test latency, FX spreads, and regulatory reporting workflows. Banks exposed to sanctioned corridors must decide whether to exit or build ring-fenced compliance layers atop XRPL, leveraging the protocol's auditability. Finally, policymakers weighing fresh SWIFT expulsions should recognize that each suspension accelerates the search for alternatives. Banning traffic may win headlines, but risks ceding long-term influence over transaction standards if blockchain networks capture critical mass. History rarely offers clean breaks, yet the compound pressures of war, sanctions, and technological leapfrogging can snap legacy systems faster than pundits expect. Should Tehran and Moscow descend into open hostilities, and if Western alliances respond by sealing the last SWIFT escape hatches, the world may witness the first large-scale migration from a half-century-old financial backbone to a decentralized ledger. Ripple's XRP is not the only contender. Central bank digital currency corridors and private stablecoin networks are racing for relevance, but it currently blends the liquidity, regulatory footprint, and real-world integrations most closely mirroring the scale SWIFT once monopolized. Whether XRP ultimately replaces SWIFT or merely complements it, the direction of travel is clear. Cross-border settlement is shifting from slow, correspondent banking toward near-instant tokenized value exchange. For participants across the spectrum, investors, banks, regulators, and everyday businesses, The prudent path is to experiment now, build optionality, and prepare for a payments landscape in which agility, not incumbency, determines who stays connected when the geopolitical tides shift next. Disclaimer: this article is for informational and educational purposes only and does not constitute financial advice, investment recommendation, or solicitation to buy or sell any asset. Always conduct your own research and consult a licensed professional before making investment decisions.